Let's talk about the US tax system. The truth is, you and your neighbor could be living off the same amount of income in retirement, and they could be paying far less in taxes than you. Why? Because our system is nuanced and they're using the rules to their advantage. As an advisor with over 14 years of experience, I want to outline the biggest mistakes I see and how you can avoid them for your retirement. The first mistake I want to talk about is not utilizing capital gains effectively, or what some refer to as tax gain harvesting. Capital gains are subject to their own tax bracket, and in some cases, you can pay 0% in federal taxes on long-term capital gains. When used effectively, it can be a great tool to lower one's taxable income in retirement. All right, let's look at an example. Jim and Sally, who both turned 65 this year, they want to live off of $120,000 and they're planning to delay Social Security. Let's look at the breakdown here. So they have $120,000 of income. Once we take a look at their deductions, and currently the enhanced senior deduction that's in effect for a few years, we see their tax bill is roughly $8,300. So they're in the 12% marginal tax bracket, but when you net it all out, they have an average tax rate of about 6.9%. Now let's look at how things change as we introduce capital gains into the equation. So again, Jim and Sally want $120,000 a year. They're both 65, so they're eligible for the enhanced senior deduction, at least for the time being. And they plan to delay taking Social Security. So in this case, let's say that they took $46,700 from their IRA, enough to equal all of their deductions, and took the rest from capital gains. Now, in this example, they have a brokerage account with just one mutual fund that's worth $750,000. For every $3 they take out, they only report $1 of gains. The other $2 is simply taking out their basis. So in this case, although they're generating $120,000 of cash flow between what they're selling of the mutual fund and what they're withdrawing from the IRA, so the capital gain is $24,430. Now, if we put that all together, that results in $120,000 of cash flow, taking some from the IRA, realizing some capital gains, and paying $0 in federal taxes. Why is that? They took essentially the deductions, wiped out the IRA. That left the only taxable income as their capital gains. We then look at the long-term capital gains brackets. They're still well within 0% because it's below $96,700, and therefore they have zero federal taxes due simply by utilizing capital gains to their advantage. The second big mistake I see retirees make involves Social Security taxes and what some call the tax torpedo. Unlike your IRA distributions or capital gains, Social Security is taxed in a nuanced and layered way. And if you don't understand how Social Security works, you could trigger an unwanted domino effect that causes you to pay more taxes than expected. Let's say you take $10,000 out of your IRA. You know you're going to owe taxes on that additional income. But within a certain range, because of how Social Security is taxed, you might also have to include an additional $8,500 of Social Security benefits that were previously tax-free. That happens because the IRS uses a formula called provisional income. And as you can see in the chart, it ranges from including 0 to as much as 85% of your benefit as taxable income. So let's look at an example. Jack and Jane Smith are 62. They plan to take $5,000 out of their IRA and collect $50,000 in Social Security benefits. Because their provisional income is $30,000, they don't have to include any of their Social Security as taxable income. Their deductions exceed the income from the IRA, and they have zero tax bill. Let's look at another example. Let's say Jack and Jane plan to use up their deductions, and instead of withdrawing $5,000, they withdraw $50,000 from their IRA and collect $50,000 of Social Security benefits. Now, at first glance, you might think your taxable income is simply $50,000 minus the $31,500 of deductions. But you can see the taxable income is actually much higher than that, because now not only do you have the increased IRA withdrawal, but because the provisional income has moved into a higher bracket, you are now having to consider the extra $45,000 that you withdrew from the IRA and $32,350 of your Social Security benefits as taxable income, resulting in a total tax bill of $5,625. This domino effect, where realizing one more dollar from this bucket is forcing you to now realize more money from your Social Security as taxable, has to do with that provisional income and these tax brackets. So the main concept is that it's on a sliding scale and not a cliff. So as you move further into that 50% threshold, you're now, as you're collecting more income, you're including more of your Social Security benefit, and that further goes up until the cap at 85%. Now, I want to use one more example to illustrate this point. Jack and Jane, as we just saw, are in the 12% marginal tax bracket. So it would be safe to assume that if they took $51,000 out of their IRA instead of $50,000, that on the extra $1,000 of income, they would owe 12% in federal taxes, $120. But as we can see here on the updated report, that's just not the case. Now they have an extra $1,850 of taxable income, leading to a $222 additional tax bill, right? 22%. That's because that extra $1,000 is now causing an extra $850 of Social Security benefits to be pulled in as taxable income. Okay, the third big mistake I want to talk about relates to Roth conversions. That tends to be a very hot topic, either for or against. Although Roth conversions done in with the right circumstances can save hundreds of thousands of dollars over somebody's lifetime, over-converting or converting in the wrong situations can prove just as costly. One of the most common situations where Roth conversions make sense is for those that have recently retired or cut back their hours and they find themselves in the gap years, where for the next few years, they expect their taxable income to be lower than it is in the future. Let's look at a long-term projection for Jack and Mary's sample. As you can see on this chart, their projected tax bill is relatively low early in retirement. Over time, as new income sources kick in, like the required distributions, Social Security, their projected tax bill is set to spike. This is a situation where Roth conversions in these early years can be done to lower the lifetime tax bill. They could instead intentionally take some of the money out of the IRA now, pay the tax bill at lower tax rates, shift the money into the Roth, where it grows tax-free, is not subject to mandatory distributions, and would be tax-free to heirs. Conversely, if their tax projections looked relatively low and stable, if they got fearful and shifted large sums of money to Roth, they could force themselves to pay a much bigger tax bill than necessary. And like we saw with Social Security, could have other unwanted domino effects. Either that's having more of their Social Security subject to taxes, perhaps having to pay higher Medicare premiums, or higher capital gains tax rates. So with Roth conversions, there's a very thin line. In the right situations, it can be very beneficial, saving you thousands. In the wrong situation, it does nothing but cost you. Those are the 3 items I wanted to talk about today. If you found the video helpful, please hit the subscribe button below. If this made you think, wait, what about my situation? Please feel free to reach out for a one-on-one conversation. Thank you.